Welcome to the Deep Dive. Today, we're diving into the world of financial decision-making in business.
Exciting stuff.
You bet. You sent over a ton of excerpts from business textbooks and academic papers.
Oh, yeah.
Yeah, all about capital budgeting, financing, and corporate restructuring.
Sounds a bit dry.
It does, right? But trust me, hidden in all this material is some real drama. We're talking corporate takeover battles.
Wow.
And we're going to uncover how some seemingly simple choices, like deciding between debt and equity, can actually make or break a company.
Yeah, it's kind of like a high-stakes game, isn't it?
It is, with millions, sometimes billions of dollars on the line.
Exactly. Like playing chess, but with way more pressure.
A financial chess match.
Yeah.
And lucky for us, we have a grandmaster with us today to break it all down.
Huh. Well, I don't know about Grandmaster, but...
You are. Our expert can help us understand even the most complex concepts and make them relatable, even if we don't work on Wall Street.
I'll do my best to connect the dots between the textbook stuff and what actually happens out there in the business world.
Perfect. So let's start with something called investment decisions under certainty.
Oh,
I know. Certainty in business, right? Kind of a funny concept.
It's true. Perfect certainty is pretty rare in the real world, but you got to start somewhere, right? Imagine you're looking at a project and you can pretty accurately predict how much cash it's going to bring in.
So a pretty safe bet.
Exactly.
Yeah.
Like those super reliable bonds, they pay out interest without fail.
Okay, got it. So that's like our baseline. But the interesting part is that these certainty techniques, they're also used in project management.
Oh, interesting.
Yeah. So even in a world where deadlines change and things pop up, there are some things you can plan for, with some degree of certainty.
Right, things that are more predictable.
Exactly, like how much you're going to pay your team, the cost of materials right now, stuff like that.
You can usually lock those in.
Yeah, and the challenge comes when you've got a bunch of great ideas, but you only have enough money for one or two.
Tough choices. So how do you decide?
That's where our friend NPV comes in, net present value, right? It's like a magic formula that tells you which project is going to be the most profitable.
Uh-huh. Not magic, but it is a powerful tool. Think of it like this. NPV weighs the future value of those cash flows against how much you got to spend today.
Okay, so it's not just about how much money you make, but also when you make it.
Exactly, because $1 today is worth more than $1 tomorrow. That's what we call the time value of money.
Makes sense. Got to invest that dollar today, watch it grow.
Right, so if a project has a positive NPV, it means those future returns are worth more than the upfront cost. Green light.
Okay, love it. But now let's flip it and think about how businesses actually get the money in the first place. That's where financing decisions come in.
Debt versus equity, the classic dilemma.
Right. Should a company take out loans, which means going into debt, or raise money by selling ownership, equity?
It's like deciding how to buy a house. Do you take out a mortgage or use your savings?
Exactly. Each one has pros and cons.
With debt, you have to make those interest payments no matter what.
But if things go south, it can really magnify losses.
Right. With equity, you're sharing those profits with investors.
But it gives you more flexibility.
Exactly. So the goal is to find that sweet spot, the optimal balance between debt and equity for that specific business.
It all comes back to that chicken and egg problem, doesn't it? Do you decide on the project first and then figure out the money? Or does how much you can borrow determine what projects you even consider?
It's a real debate. Some folks say that spotting a great opportunity comes first, then you scramble for the funds.
Right. You see that golden ticket and you've got to find a way.
Others argue that your current financial situation, how much debt you can handle, really limits what you can take on.
So which is it? Chicken or the egg?
The sources actually say these decisions are completely intertwined. It's not a step-by-step thing. It's more like a dance.
A dance between what you want to do and what you can afford to do.
Exactly. Let's say there's a tech startup about to launch a killer app. They need cash for marketing and development, but they're already loaded with debt.
Oh.
And banks are hesitant to loan them more, especially for something as risky as a new app.
So they're stuck.
They got to scale back their dreams or find investors, which means giving up some control.
Even in the tech world, it's not just about the idea, it's about the money.
And ultimately, it all boils down to this big concept, maximizing shareholder wealth.
Now that sounds a bit, I don't know, like a Wall Street villain.
Haha, I get it, but it's really about making sure the business is healthy and sustainable.
Because a healthy business benefits everyone, the workers, the customers, even the shareholders.
And maximizing shareholder wealth isn't just about chasing those short-term profits.
Right. Got to think long term.
In fact, a company can actually hurt its share price by focusing too much on quick wins and neglecting those long-term investments.
Like research and development, new product development, that kind of thing.
Exactly. Our sources talk about a company that announced record profits, but their share price tanked.
Why is that?
Because they hadn't invested in innovation, so investors saw trouble on the horizon.
So investors are smart. They're not fooled by just a single good year.
Right, they're looking for that sustainable growth.
Which brings us to another important idea, the time value of money.
A classic.
It seems obvious, right? Money today is worth more than the same amount later on.
Because you can invest it now and hopefully it'll grow.
Exactly. Like if you offer me Rs100 today or Rs100 a year from now,
You'd take the Rs100 today.
of course, I could put it in a savings account or even better, invest it in something that might give me a higher return.
Exactly. Time value of money in action. And this is super important when you're thinking about IRR or internal rate of return. It's like figuring out the effective interest rate built into an investment. Like if you're comparing different projects, you can use IRR to see which one gives you the best return over time.
So IRR is kind of like comparing loan offers from different banks. You're trying to find the one with the best interest rate.
That's a good way to think about it. Now, what about the cost of capital? That's not just about interest on loans, is it?
Right. What else is there?
It includes the cost of all the financing, debt, equity, and even those hybrid things like preferred stock.
So it's the whole picture, the true cost of getting that money.
And here's a curveball. The cost of equity is actually trickier to figure out than the cost of debt. With debt, it's pretty simple. It's the interest rate.
But equity, it's ownership, right?
And what investors expect to earn on their equity, well, it depends on how risky they think the business is.
Oh, so it depends on things like market conditions,
Yeah,
even just how people feel about the company.
exactly. It's almost like trying to read the collective mind of the market.
So how do companies even begin to estimate this mysterious cost of equity?
There are a few ways. One common one is the CAPM, the capital asset pricing model.
What does that do?
It calculates the expected return on an investment based on its risk compared to the overall market. It uses something called beta to measure that risk, but we'll save that for another deep dive.
Okay, good. My brain is already doing financial gymnastics here, trying to keep up.
No worries, we'll get there.
Okay, so let's move on to capital structure decisions.
Yeah,
This is where companies figure out that ideal mix of debt and equity, right? Like what's the magic recipe that's going to make their business the most valuable?
that's the holy grail. And there are a bunch of approaches to find that perfect mix. The sources talk about EBIT EPS analysis and ROE analysis.
Those sound complicated.
Don't worry, they use a real company as an example, Raj Cosmetics Ltd, to show how these analyses affect a company's earnings per share, EPS.
And EPS is a big deal because it directly impacts the share price.
Exactly. So it's not just theoretical. It's about real companies making real choices that impact their bottom line and ultimately the wealth of their shareholders.
Speaking of which, have you ever thought about the debt-to-equity ratio of companies you invest in? What factors do you think are most important when you're looking at a company's financial health?
That's a great question, and one our listeners can ponder as well.
For sure. Okay, let's shift gears and think about how project management fits into all of this.
Sure.
It's not like businesses just make financial decisions in a vacuum. These choices are usually tied to specific projects, right?
Absolutely. We're talking about the big, long-term projects that can make or break a company. Our sources really stress the importance of having a solid project plan, one that lays out not just the steps, but also what you want to achieve in the end.
So it's more than a to-do list. It's like a roadmap guiding the whole project.
Right, from that first spark of an idea to the finish line.
So what are the essential ingredients of a successful project plan?
First off, got to be crystal clear about what you're trying to do and the scope of the project.
What you're aiming for and where the boundaries are.
Yeah, then break it down into smaller chunks, each with specific deliverables and deadlines.
Got to keep things moving.
Exactly. And of course, you need a realistic budget and timeline.
That accounts for potential problems and things that might hold you back.
It's a lot of planning, but it's worth it.
Definitely. And once you have that plan, you need a way to figure out if the project is actually financially viable.
Right. Got to make sure it makes sense financially. The sources talk about different investment appraisal techniques.
Give us some examples.
Like the payback method.
Which focuses on how fast you get your money back, right?
Exactly. And the return on asset method.
Which looks at the return generated by the project's assets.
Right. And of course, our old pal NPV comes back into play.
It's all connected. So for our listener out there, How would you evaluate an investment opportunity? Would you want to get your money back quickly, focus on maximizing return on assets, or take that longer view with NPV? Let us know.
So all these financial models and techniques, they're really helpful, but they tend to assume we can predict the future.
Which is, well, impossible.
Exactly. Which brings us to investment decisions under uncertainty.
That's where things get really interesting.
Right. We're stepping into the messy, unpredictable world of business where those neat financial models collide with reality.
So how do businesses handle this uncertainty? Do they just cross their fingers and hope for the best?
Hopefully not. Our sources make a key distinction between risk and uncertainty.
Okay, what's the difference?
Risk is something you can measure, you can assign probabilities to it.
So like flipping a coin. There's a 50-50 chance for heads or tails.
Right. But uncertainty, that's the wild card, the unknown unknown.
You don't even know what could happen.
Exactly. Think about trying to predict what the next big internet trend is going to be.
Good luck with that. So how do businesses make investment decisions when they're facing so much uncertainty?
Well, for starters, they can try to understand the different levels of uncertainty they're dealing with. The sources have a good example comparing two investment proposals, A and B, each with a different risk level. Proposal A offers a smaller potential return, but with a higher chance of success. Proposal B, on the other hand, could bring in a huge payout, but the odds of hitting that jackpot are slim.
The classic risk versus reward dilemma.
Exactly. And the right choice depends on how much risk the company's willing to take, their financial situation, and their overall goals.
Makes sense. Well, we've covered a lot of ground in this first part of our deep dive.
We sure have.
We've talked about NPV, the time value of money, even the wild world of uncertainty. But there's so much more to explore, so stay tuned for part 2 of our deep dive into business finance.
Yeah, wait.
Welcome back to the deep dive. Before the break, we were talking about risk and uncertainty in business and how companies try to, navigate those tricky waters when they're making investment decisions.
Yeah, it's like sailing through a fog. You can't always see what's ahead.
Exactly. So how do companies avoid those financial icebergs?
Well, they can use the right tools to, assess and manage that risk.
Okay, so what kind of tools are we talking about?
Well, there are quantitative tools like standard deviation and coefficient of variation.
Those sound pretty technical.
They are, but they basically help measure how spread out the potential outcomes are.
So it's like understanding the range of temperatures you might get in a season helps you pack the right clothes.
Exactly. If a project has a high standard deviation, it means the possible outcomes are all over the place. Very unpredictable.
Okay, makes sense. But what about the qualitative side of risk? How do businesses assess those risks that you can't really capture with numbers alone?
That's where things like sensitivity analysis and scenario planning come in.
So like what-if scenarios.
Exactly. With sensitivity analysis, you're basically saying, what if our sales are lower than we expect? What if the cost of materials goes way up?
So you're testing those assumptions.
Right. And scenario planning takes it even further, creating a bunch of possible future situations.
From the best case to the worst case.
Exactly. And you come up with a plan for how to handle each one.
Like a chess player, thinking several moves ahead.
Right. And one powerful tool that can help with scenario planning is something called Monte Carlo simulation.
Monte Carlo?
It-
Sounds fancy.
It's basically a way to run a bunch of virtual experiments on the computer.
So instead of just having one projection, you get to see a whole range of possibilities.
Exactly. It's a way to embrace the uncertainty and use it to your advantage.
I like it. So let's shift gears a bit and talk about where businesses can raise capital. Our sources talk about both domestic and global markets.
It's a huge playing field with a ton of options for companies to get funding.
So let's start with the domestic market here in India. What are some of the key instruments available?
Well, you've got the classic equity shares. Those represent ownership in the company,
Right, and then there are preference shares
which pay a fixed dividend.
and debentures, which are long-term debt instruments.
Exactly. And of course, you've got bonds as well, another form of debt.
So many options.
It's about choosing the right tool for the job. Like you wouldn't use a hammer to screw in a light bulb.
Exactly. Companies need to carefully consider what they need, how much risk they're comfortable with, and what the market's doing at the time.
Right. It's all about making strategic choices.
And these days, businesses aren't limited to just their domestic markets. They can tap into global capital markets as well.
Exactly. Things like global depository receipts or GDRs let companies list their shares on foreign stock exchanges.
So it's like a passport for their shares, giving them access to a much bigger pool of investors.
Exactly. It opens up a whole new world of possibilities for growth. And it's not just about equity. Companies can also tap into global debt markets through instruments like Eurobonds and foreign currency convertible bonds, FCCBs.
It's amazing how interconnected the global financial system is these days.
It really is. Money can flow across borders with incredible speed and efficiency.
And speaking of evolving, the financial instruments themselves have also been changing.
Welcome to the world of financial engineering. This is where people come up with innovative ways to structure financial instruments to meet the specific needs of borrowers and lenders.
Our sources mention some interesting examples of debt instruments that have been developed through financial engineering.
Yeah, things like auction rate notes and bonds that are linked to commodity prices.
So it's like taking the basic building blocks of finance and creating entirely new structures.
Exactly. And it's not just about debt. Financial engineering has also led to new equity products like non-voting shares and hybrid instruments that combine features of both debt and equity. It's all about pushing the boundaries and coming up with new solutions.
That's so cool. And now we come to a particularly intriguing corner of finance. Derivatives.
Derivatives. Financial instruments that get their value from something else, an underlying asset.
So their fate is tied to something else, like a stock, a bond, a commodity, even a currency.
Right, like financial sidekicks. Our sources focus on futures and options, two of the most common types.
Write those down. What are futures?
Futures are contracts to buy or sell something at a set price on a future date. They're great for hedging, letting businesses lock in prices and protect themselves against those crazy market swings.
So like a farmer using futures to lock in a price for their crops, even if the market price drops later on.
Exactly. Now, options, they're like futures, but more flexible. They give you the right, but not the obligation, to buy or sell something at a specific price within a certain time frame.
So you can benefit if the market moves in your favor, but you're not stuck if it doesn't.
Exactly. It's a way to manage risk while still keeping your options open.
I like it. So we've covered a lot of ground here, different types of financing, the world of derivatives, but there's one key aspect of financial management we haven't talked about yet. Investor relations, or IR.
IR is all about building strong relationships with investors.
Communication is key, right?
Absolutely. It's about transparency, building trust, and making sure investors understand the company's story.
And in today's world, where there's so much information out there, IR is more important than ever, would you say?
Absolutely. Companies need to be proactive in explaining their strategy and showcasing their performance. It's not just about putting out dry financial reports, it's about engaging with investors and addressing their concerns.
Our sources give a good overview of the corporate form of business, highlighting all the key players, shareholders, institutions, regulators. It's a reminder that businesses exist within this complex web of relationships.
And within that web, transparency and accountability are crucial. Companies need to be clear and consistent in how they disclose information, following the rules while also meeting the expectations of investors and other stakeholders.
The balancing act, right?
Exactly. Companies need to be open without giving away sensitive information that could hurt them competitively.
So what about the people who handle all this, the investor relations professionals? What do they do?
They're like the bridge between the company and its investors, responsible for communicating the company's story, managing investor expectations, and building those long-term relationships.
Well, they get a tough job.
It can be, but also very rewarding. They need to be great communicators, both written and verbal.
And they need to be able to explain complex financial concepts in a way that everyone can understand.
Right. It's not just about crunching numbers. It's about being a storyteller, a relationship builder, and a strategic thinker.
So we've covered a ton of ground in this deep dive. We've talked about traditional financing options, the world of financial engineering, the importance of investor relations, and even how companies deal with risk and uncertainty. But there's still more to come.
Stay tuned for our final segment, where we'll explore some non-traditional financing options, dive into corporate restructuring, and wrap up with some key takeaways for our listeners.
Welcome back to the Deep Dive. We've been exploring all sorts of things in the world of business finance, from the basics to those more complex ideas like managing risk and investor relations.
It's been quite a journey.
It has. Now we're going to look into some financing options that are, a bit outside the box.
Yeah, it's not always just about debt and equity. There are other ways for businesses to raise capital.
Right, those non-traditional options. The sources talk about leasing, asset securitization, and venture capital. Those sound pretty interesting.
They are. Each one has its own, pluses and minuses. Let's start with leasing.
Okay, good idea. I feel like most people would probably lease something in their lives, like a car.
Exactly. It's a way to use something without actually owning it.
So you get the benefits without that long-term commitment.
Right. And for businesses, it can be a great way to get expensive equipment or even real estate without spending a ton of money up front.
It frees up their cash for other things.
Especially for growing businesses, that can be really important.
Makes sense. What about asset securitization? That sounds a bit more, I don't know, complicated.
It is a bit more involved. Imagine a company has a bunch of assets that are hard to sell quickly, things like mortgages or loans.
Yeah.
With asset securitization, they can bundle all those assets together and turn them into tradable securities.
So it's like taking a bunch of separate pieces and creating something new that investors want to buy.
Exactly. It lets companies unlock the value that's tied up in those assets and raise capital more efficiently.
Okay, that's pretty clever. And finally, there's venture capital, the world of investing in startups.
Right. Venture capitalists are looking for those young companies with huge growth potential.
The ones that could really take off.
They provide funding in exchange for ownership and often help guide those startups along the way.
So it's not just about the money, it's about the expertise and connections they bring.
Exactly. Our sources talk about how these non-traditional options have become increasingly important, especially in today's market where things change so fast.
They give businesses more choices and flexibility.
Right. It's like having a whole toolbox of options to pick from.
Love that analogy. Speaking of options, the sources also mentioned commercial paper and factoring. Those are more for short-term needs, right?
Exactly. They help companies bridge those gaps in cash flow. Commercial paper is basically a short-term loan.
Kind of like an IOU.
Sort of, yeah.
Mm-hmm.
And factoring is where a business sells its unpaid invoices to someone else at a discount.
So they get cash right away, even though the invoices haven't been paid yet.
Right. It can be a lifesaver for businesses that need cash quickly.
Okay, makes sense.
Yeah.
So we've covered a lot of ground with financing, but now let's talk about corporate restructuring. That sounds pretty intense.
It can be. Restructuring means making big changes to a company's financial or operational structure.
We're talking mergers, acquisitions, even those hostile takeovers.
The whole shebang. It's like a corporate makeover on a massive scale.
So why would a company go through all that?
Lots of reasons. Sometimes it's about adapting to changes in the market.
Gotta stay competitive.
Or it could be about becoming more efficient, streamlining things.
And sometimes it's just about survival, right?
Yeah, a struggling company might merge with a competitor just to stay afloat.
Wow, high stakes. Our sources break down mergers and acquisitions into different categories, like horizontal, vertical, and conglomerate mergers.
Right, it's like learning the family tree of the corporate world.
Exactly. So horizontal mergers are when companies in the same industry join forces.
Often competitors, yeah.
Vertical mergers bring together companies at different stages of the supply chain.
Like a manufacturer merging with a distributor, they're working together, but at different points in the process.
Okay, I'm following. And then there are conglomerate mergers, which are companies from completely different industries coming together.
Exactly. And it's fascinating to see how all these mergers can completely change industries.
Creating new giants and shifting the power dynamics.
Right. It's not just about getting bigger, though. Mergers can be about a lot of things. Reducing costs, expanding into new markets, acquiring new technologies or talent, even just eliminating a competitor.
So it's a strategic game with high stakes.
Absolutely. And as with any big decision, there are risks involved.
Like what?
Well, merging two different company cultures can be really tough, and those anticipated benefits don't always pan out.
It's like trying to blend two families together. It takes a lot of work.
Exactly. And then there are those hostile takeovers. Those are like something straight out of a movie.
So dramatic. What exactly is a hostile takeover?
That's when one company tries to take over another one, even though the management and board of directors don't want it.
So it's a battle for control out in the open.
It can be very intense with both companies trying to win over investors and get the upper hand.
Our sources even mention some famous Indian takeover kings, people who built their careers on acquiring and restructuring companies.
It's a high-pressure, high-reward world.
For sure. So if a company is facing a hostile takeover, what can they do to defend themselves?
They've got some strategies. They can use things like poison pills, which make the company less attractive to the acquirer, or they can find a white knight, a friendly company that comes in with a better offer.
It's like a game of corporate chess.
Exactly. And mergers and acquisitions are just one part of restructuring. There are other options too.
Like what?
Well, there's divestiture, which is basically the opposite of an acquisition. It's when a company sells off a part of its business.
So sometimes getting smaller can actually be a good thing.
Right. It can help a company focus on what they do best.
Our sources give an example of an Indian company, Hindustan Lever, that's used both acquisitions and divestitures as part of its restructuring.
It shows that restructuring isn't always about getting bigger, it's about making the company stronger.
Makes sense. What about leveraged buyouts? Those sound pretty intense.
They can be. That's when a company is taken private using a lot of borrowed money.
So it's like taking out a massive loan to buy a company.
Yeah, pretty much. Leveraged buyouts are usually done by private equity firms. They use the acquired company's assets and cash flow to pay off that debt and then hopefully sell the company for a profit.
High risk, high reward.
Exactly. And that's not even all of it. There's also leveraged recapitalization, where a company takes on debt to fund things like dividends and reorganization of capital, where they adjust the mix of debt and equity to improve their financial health.
Wow, it's a whole toolbox of options.
It really is. Companies can use these tools to adapt and evolve to thrive in this constantly changing world.
So we've covered a lot of ground in this deep dive into business finance. We've learned about those key concepts like NPV and the time value of money, and we've explored the world of corporate restructuring.
We've seen how companies handle risk, how they get funding, and how they stay ahead in a global market that never stands still.
But this is just the starting point, dear listener. What we've done is given you a framework for understanding how the financial world works.
Now it's your turn to apply what you've learned, ask those tough questions, and keep exploring with a curious mind.
Financial literacy is a journey, not a destination. The more you know, the better decisions you can make, whether you're managing your own money, investing, or even starting your own business.
Exactly. It's all about empowering yourself.
Thank you so much for joining us on this deep dive. We hope you've enjoyed it as much as we have. And until next time, keep learning, keep exploring, and keep asking those great questions.